The broadcast is now starting. All attendees are in listen-only mode.
All right, good afternoon, everyone. This is Bobby Rains back again for another of our members-only workshops. We do these every 3 weeks. So here we are again. Let's go over the agenda. First, we're going to have a little update on the market, and then we will talk about what's going on at InvestorsObserver. And then the bulk of the conversation is member-driven content. That means questions from you guys. I have a couple that people sent in early that I got some slides together for. But anything else that comes up, either while I'm talking or something completely unrelated, throw it in the question box and we will try to get to it at some point today. As always, I can prepare slides for questions submitted ahead of time. Just send me a note and mention workshop, and we'll try to get to those as much as we can. All right, so market update. This dashed line at 2,800 is pretty much the story right now. I mean, there's a lot of earnings and stuff we'll talk about in a minute, but this is the last month, and we've been very close to this thing since I think this is about July the 6th, 9th. Somewhere in here, yeah, that's the Monday after the 4th of July. We've been, tried to break out to the upside a couple of times. And yeah, just can't really get away from the 2,800 line. I mean, there's a lot of moving pieces there in terms of earnings and some things going up and some things going down. So it's not quite as simple as this. But even today with the Fed announcement there and a blowout from Apple yesterday, there's just not a lot of momentum to move, it seems, in either direction away from this 2,800. The other analysts and I feel like we've been talking about 2,800 forever, over and over again. And we kind of have. It's been important resistance a couple other times earlier this year, and we've been on top of it for a while, but we can't really seem to get away from it at all to the upside. The major indices here, you can see earlier in the year the techs, small cap and tech. That's the blue and the green there. So small caps in the Nasdaq outperformed. They've come back in a little bit, whereas the S&P and the Dow have lagged for the year, but are not have made up a little bit of that ground recently. There's still a decent divergence there. I mean the S&P this is a percent change for the year, so we're looking at the S&P. I think that rounds to flat in any case, but there's no returns on this chart that anybody should be super excited about. So yeah, I mean, that's where we are with the major indices. Techs had been strong and small caps had been strong. Earnings didn't do so good there. It's mostly, as we'll talk about in a second, mostly the major names. A few big names really hurt things, but also the market seems to be particularly picky this year, or this time through. So yeah, that's another sort of thing to watch out for, is just Apple beat on basically every line, and they've done fairly well today, but the market seems to have sort of picked out a few things to really punish people for this time through. All right, so what else is going on besides my bullets being out of order? All right, so earnings generally have been good. This bit is from our Friday blog post. FactSet only updates these numbers once a week, but as of Friday, 53% of the S&P had reported, and 83% had topped estimates. 73 had beat on sales. Earnings guidance has generally, the forward guidance has also generally been relatively strong, where they're all still predicting earnings growth for the most part. So earnings generally hasn't been that bad. We had some big misses from the FANG names. Facebook, not so good. Netflix, not so good. Amazon doesn't really care about the Wall Street earnings game. I mean, they had a line. Their forward guidance line was for free cash flow of between 1.4 and 2.4 billion in the current quarter, which, I mean, if you're giving a range between 1 billion and 2 billion, what you're saying is, hey, we're going to make some money. We don't really care about you. So it's hard to take anything away from Amazon's earnings. To be honest, like, they don't really seem to care very much about hitting expectations or meeting expectations or even setting expectations, right? I mean, if you're providing a range that's $1 billion wide, yeah, they don't really care about hitting expectations. So it's hard to take anything away from their earnings, other than just they continue to not really care about Wall Street. But yeah, so I mean, Facebook, and I mean, outside of the FANG, Twitter also missed those, right? I mean, those misses seem to be largely about issues specific to social media. Google had a pretty good quarter. It got dragged down when Facebook, and then especially after Twitter, all the tech sort of had a weak Friday. But that's one that we liked. They actually had a good earnings report, but it got pulled down by everyone else. The trade picture sort of seemed to be improving. There had been no news for a while, and there were reports yesterday that there were, I mean, essentially the headline was talks about restarting talks, but that's something at least. But then, then we got reports yesterday evening that they were thinking about raising tariffs from 10% to 25% on some Chinese goods. So that's, probably not a good sign, but really sort of who knows. Apple had a great quarter. That could help semis if the trade news is good. The semiconductor space is all over the world. And to this point, tariffs have pretty much been limited to goods crossing international borders. So that could hurt the semis, even despite Apple doing well. And even then, Apple's, if you dig into their earnings report a little bit, they had growth in device sales and things like that. But what they seem to be really focused on is trying to push the higher end devices and worrying less about volume, which maybe is good for suppliers, maybe not. It's a little bit harder to tell. But yeah, so that's kind of where we are. There's some other earnings stuff to come on. Railroads have all done well. Some of the transportation stuff is doing pretty well. And then there's some individual names here and there that have done well, but it's hard to find any huge trends right now. All right, so that's the market update. Before we get into that, let's talk about what's new at Investors Observer. Since our last workshop, we combined our sister site, the Market Intelligence Center, into the Investors Observer, so it's all on the same website now. It's available. We also moved the navigation. We've gotten some complaints from people about, I think on smaller monitors, this gets a little narrow. This 3 horizontal lines here, I'm told web developers refer to this as a hamburger menu or a hamburger control. So if you click on those 3 lines there, or the hamburger, it will collapse the menu if you want to view the website content wider, and then you can pop this back out to get to the menu. But yeah, you can get to the Market Intelligence Center here, and we sort of got rid of the blog section of the website that we had previously. All of that content will feed into here as well, though, as well as the morning update. And we have some categories down here, so you can still find, right, members-only workshops. This will show up here tomorrow if you're logged in. But we have stocks to watch, the week in review, market week ahead. All the stuff that used to be in the blog is now found in the Market Intelligence Center section of the website, as well as all the content that has been traditionally in the Market Intelligence Center. All right, so that's what's new in Investors Observer. Rick, semis, sorry, that's semiconductors. All your chip makers and things like that. That's the semiconductor or semi space. All right, so we had a question from Tony in the last workshop about trading credit spreads around earnings. And I feel like I'm going to do this with both of the questions that I pre-prepared. But I'm going to argue with the premise a little bit because Tony wanted to know, how do I find good credit spreads to make ahead of earnings? And my general feeling on that is don't. And the reason for that is, and I pulled these from a webinar I did some time ago. I don't remember the underlying stock here, but the point is the same, and it's a retail name. I do remember that. So the two arrows are earnings reports. You can make a lot of money here if you know what's going to happen, but if you don't know what's going to happen, you're going to get murdered, especially with credit spreads, right? I mean, if you're doing $5 wide credit spreads and the stock moves by $13, that's a full loss if you're on the wrong side of it. And then, right, so if we look at what the actual note here was, right, the company beat on the top and bottom line. Management said same-store sales were soft due to weak footfall and lower e-commerce conversion rates, right? So earnings were actually good, but same-store sales were a little bit weak, and this happened, right? So generally, this is the kind of reason we try to avoid earnings. We've had a couple of cases this year where we didn't avoid earnings and it didn't go so well. Again, that was, there's reasons for that. And we, try really hard to avoid having trades open during earnings for the most part because of exactly this. So typically we try to stay away from sort of, you get higher premiums. That's why it's an attractive trade. You can get some higher premiums, but those higher premiums are because of the implied volatility by, knowing that stocks can make these gigantic moves. So what we typically prefer to do is this kind of thing, okay? So the green arrow, yellow arrow, I'm a bit colorblind, whatever color that arrow is when the company reported earnings. And so if you look at this, right, we have earnings here, and then there's just there's a jump and then a drift. And so sure, it would be nice if you could somehow capitalize on the jump, but if you're doing a credit spread, all you really need is for the stock to stay above or below your sold option. And in that case, right, this sort of thing where it's like, oh, well, earnings were strong, the stock should be strong for a while. That's really all you need. And the extra premium you get for selling that call or selling those options ahead of earnings are in most cases not worth the risk, unless you have a really good idea what earnings are going to be. But that's not the case here where we are. So here's another case where we did Microsoft. Earnings were on, and this isn't this year. This is again from a presentation I did a while ago. Last year, it appears. So earnings were January the 26th. We made a trade a couple days later after the stock had gone up and sold back some, but we liked what the earnings report said, and so we were comfortable getting into the trade. And so we closed this. We didn't make the full profit. We could have made the full profit if we had made a little bit longer trade. But you can do that in this kind of thing, right? Like find a company you like and make a trade, and then do it after earnings. Wait for the earnings report to come out and make sure they say something you like, and then make a trade. Seems to us to be a much better strategy than trying to guess what earnings are going to be and taking a really, in most cases, modestly higher premium in exchange for that. All right, so that's our first question. And our second question was about position sizing, and this question is from Jason, and I actually pulled it in here because it's relatively complicated. So if you subscribe to, say, all three portfolios and want to put equal amount in each trade, right, Jason says equal sizing for covered calls and diagonals is easier to do than verticals, which makes sense. Is there a recommended weighting per each service? And I kind of hate to do this because people don't like it when you do this, but I'm going to kind of argue with the premise of the question. I don't think that equal weighted position sizing across these three strategies is a particularly good idea. And so equal position sizing in the portfolio can make sense. Okay, so it can be difficult in covered calls because it takes a lot of money. But if you can, right, like if we put on a covered call on a $20 stock and a covered call on a $40 stock, we don't necessarily like the $40 stock twice as much. It's just it costs twice as much to make that position. So if you can do 2 contracts with the 20 and one of the 40, that might be reasonable. But again, right, covered calls portfolio, doing that can be pretty expensive. So we don't really expect that to happen. But the reason I don't like doing it across the strategies is the risks are different. Like I don't think we've ever had a 100% loser in the covered calls portfolio that would require a stock to go to zero, which to my knowledge has never happened. It does happen. We've had a couple in 2018 in the vertical spreads. It does happen there. And so I certainly wouldn't want to put a covered call size position on in a vertical spread because I don't want to lose 100% of a covered call size position. And so the likelihood of outcomes, if you want to think about it, is very different, right? So in a covered call, right, going to zero is, I won't say impossible, but it's somewhere relatively close to impossible. In diagonal spreads, you're looking at a move usually definitely of double-digit percentages, sometimes 25 or 30% in order to get a full loss. Again, it's happened once or twice, but for a stock to lose 30%, it takes something pretty big to happen, and it doesn't happen that often. But vertical spreads, a 10% move or less can wipe out an entire position. And also, right, diagonal spread, something goes down 30%, we've got some time, we can let the sold call expire, we can try to sell another one and wait for it to come back. Vertical spreads, we kind of get one shot. There is no letting something expire and holding onto a bought leg because everything expires at the same time. So for that reason, I don't think doing equal position sizing in the different strategies is a good idea. What I think you're actually looking for is kind of a value at risk model, which you can Google. There's tons of literature about, which essentially looks at how much can each position reasonably lose, and then you would sort of try to equal weight that. The problem with that is there's a whole lot of sort of guesses or assumptions that you have to make, and I'm not really comfortable trying to do that for each position. And then, it would be a lot of work. And I don't think a thing that's particularly useful. I mean, there may be some nominal gains to get from making some positions bigger and some smaller. But I don't even know how to tell you what that would be or if there would be gains from that. But those are kind of my thoughts on the question in any case. And these are my favorite kind of questions because they're kind of theoretical. And I like the thinking in terms of like how do I invest smarter. But I don't think that this is actually the way to do it. Like I would not put the same amount of money in a vertical spread that I would in a covered call. But you are right, Jason, that the margin amount is essentially what you would how you would count the position size. So if it's a $5 wide spread, you'd count that as $5 or $500, however you're doing that. All right, so that is all the slides I put together. So any questions you have, I see some starting to tick in now. Any questions you have, please put them in the question box and we will get to them. All right, let me click back over to Investors Observer here so we can look at some things here. All right, so let's see here. Sylvia, I'm not sure exactly what Equinox is, and I don't remember having that in the covered call portfolio. It's certainly possible that things you find in Trade Idea Generator could lose big amounts. We put trades on every stock imaginable and then try to give you all the information to make the right decisions. But yeah, outside of that, I'm not sure. I don't recognize the name. If you have a ticker symbol or something, I'd be glad to take a look at it. All right, so Ted says LHCG. So Ted says this says no trades available. Perhaps you're looking at a different day, Ted. I'm not exactly sure. It looks like, if I had to guess just from the information provided here, if I had to guess just from the information provided here, the strikes are pretty wide, probably $5 or so, and probably no weekly options available. Having fewer options available makes it harder to find a trade. So sometimes we may not have a trade for something like this. I mean, if you look at the key ratings, 3s and 2s, and a 1, not particularly great. And yeah, not without knowing what time you looked this morning. Potentially you looked before today's trades got published and we didn't have any trades yesterday. I'm not exactly sure. But yeah, this seems like the sort of thing. It's certainly the sort of thing that has options we would try to pick a trade for. But yeah, it also seems like there may not be very many trades available some days just because of the way the options are structured. All right, so okay, I think I remember this. I think this was one we've talked about before in terms of having crazy high option premium. And yeah, clinical stage pharmaceutical, you find high option premiums there, and this is kind of the reason why. Because yeah, it only takes a failed drug trial or two to really whack the stock. I mean, if I remember, this was the kind of thing that had something like 50% downside protection. That obviously exceeds the 50% downside protection there. It really got whacked, but yeah, it's those high option premiums in the biotech and pharmaceutical space. They're there for a reason, and that reason is, yeah, drug trials are wildly unpredictable, and not just wildly unpredictable in terms of the outcome, but also we've had very difficult times even finding a reliable schedule for when we think things might come out. So you got an unreliable outcome coupled with unreliable timing. It makes it very hard to trade around or trade on or anything else. So yeah, that certainly got whacked. And yeah, it seems like they either no longer have options or we didn't have trades available for them today. I can't tell exactly which it is at this point from here, but yeah, that's pretty ugly. All right, so here's a question from Buddy. He says, how do we calculate the probability that an option will something? Is there a formula? So my guess, Buddy, and correct me if I'm wrong, is you're asking about out there. Probability of expiring worthless. So the probability of expiring worthless is, essentially the inverse. The probability of expiring worthless is essentially the inverse to the probability that an option will be assigned. And generally, delta, we don't provide delta here. Your brokerage account should have delta. We do have the probability of expiring worthless. So, right, if it has a 79% chance of expiring worthless, that says 21% chance of being assigned. So that's that's the gist of it there. The actual formula for calculating delta is incredibly complicated. In short, it turns out delta is kind of cool because it is both the amount that the price of an option will move for a given move in the price of the stock, and also the probability that the option will be assigned. So if you look at a deep in the money call option, right, for every dollar the stock goes up, the price of that call will also go up by $1 because you've got basically no time value and you're just adding intrinsic value. If you know anything about probability, you know the probability of 1, which is what that delta would be. A probability of 1 means that something is essentially going to happen. So that's what happens on that end. And then on the far end, way out of the money, an option will add, it'll have a much smaller delta. It adds a much smaller dollar amount for a corresponding dollar move in the stock. And so, right, that's a low probability. And then right near the money, if you have a perfectly at the money option, typically the delta will be right around 50. And that's also the probability, right? 50-50. And so that's how that works. And then, so our probability of expiring worthless, for sold puts and a couple of the other strategies we hear, that's the number that people actually wanted. So rather than making them flip it, we just did it there. But yeah, it's essentially that. All right, Hank has a question about Shopify, which I haven't looked at recently, but I understand that it has been beaten up. Yeah. Yeah, I mean, Shopify is the kind of thing that really got killed. Yeah, Friday of last week or so. Once Twitter came out, and I don't remember when Shopify reported, about the 26th or so, maybe. Yeah, I mean, the valuation was always high on Shopify, which is great until the market decides the valuation matters again, and then it's terrible. And I mean, right? So we had a Google trade, still have it in the vertical spreads portfolio that we got into after Google's earnings, and Google's earnings were good. And then Facebook came out, and then their earnings weren't great, and Twitter came out, and their earnings weren't great, and Google got whacked. But Google doesn't, I don't believe, have the same problems that Facebook and Twitter have. Shopify, I don't think, has the same sort of structural problems in terms of fake accounts and whatever else that Facebook and Twitter have. So I don't think those things are really related. It certainly didn't keep the stocks from all going down at the same time together, though. So at a certain point, what I think is related only matters so much. But yeah, I mean, if the momentum names start to come back, I would certainly expect Shopify to be there. But without reading their earnings report, I mean, just in looking at the chart, it's not great. You would have liked to have seen it, hold some support, or find some support right around this level here, and it just kind of blasted through that. The next level is probably somewhere in this area. So if it doesn't level off where it is, hopefully somewhere around 126.65, somewhere in there, hopefully it will level off. But yeah, without digging into their option report, I can't give you too much more insight to it than that. But also, I mean, if you look at the 52-week range between 88.21 and 177, that's a hell of a run. So yeah, if you fly a little too close to the sun every once in a while, your wings melt, I guess, is the sort of moral of that story. All right, more questions or stocks to look at. All right. Yeah, if you guys have questions, I've booked the hour. I'd be happy to talk about anything you're interested in hearing about. All right, so Bud, the regression channel, you can find, I believe it's the scale. Nope. Indicators. Yeah. So, yeah, linear regression is, I believe, what you're looking for. You can click that on like that. And then this little gear, you can update the settings. So standard deviation of 2 means that it's somewhere 98 or so. I don't remember off the top of my head. Somewhere around that percent of staying in that range. And so then you can change. Count is essentially, it depends if you're looking at days or hours, but it's essentially number of units. So this is 100 days, it looks like. Goes back to March. You can make it go longer. If you wanted to do 200 days, it will actually, yeah, so you can see it narrows down the range a little bit and pops it out. So yeah, that's what that looks like. I mean, yes, there's a little bit of overfitting going on with linear regression, but you can also see, right, Shopify is a good example to have here that, I mean, essentially the channel gets fit onto the data and then things that are outside of the standard deviations pop out. So you can see that, right, 90 whatever percent of the time it's inside the channel, and then sometimes here and here recently it's popped out. So I mean, you can see this move here is, right, if the from the midpoint to the edge is 1 standard deviation. This is a several standard deviation move from peak to trough here. Maybe that might be 3 or so. So yeah, that's a big move and the kind of thing that's unexpected. But I mean, what you like to see is a relatively not only something that stays in its channel, but also something that is has a tighter channel as a percentage of the stock price. So for $100 and even $180 stock to have a channel that's, we'll call that $35 wide, is a pretty big big, right up here, big channel. It means the stock swings around a lot. We can go look at something like, what's a good one? This might not be the best because they just reported earnings, but it's, I bet, narrower than we saw on Shopify. Pop this back out to 200 just so it's apples to apples. Yeah, so you got like the channel here is like 10%, whereas on Shopify it was about 20%, 15 or 20%. Right, and you can see Microsoft has peaked out of its channel once or twice, but it's a lot narrower as a percentage of the stock price. So that's the kind of thing we typically like to see. You'll get lower option premiums for that, but I mean, like we just looked at with AQXP, making a trade based on giant option premiums is not necessarily the best way to pick it. All right, Ted has a question about Garmin. Garmin made a big move today after earnings. So yeah, Ted, if it makes a big gap, the things you want to look at, let me see if I can flip this over here. There we go. Yeah, so what you like to see with a stock that makes a big gap is, one, for it to make a big gap and then make a green candle instead of a red candle. And then also for it to, so the narrower the candle and the longer these wicks, that's typically a sign of indecision. So something like this where it came all the way back and closed the gap, but it's still up on the day. I wouldn't, yeah. The hard part about trading and knowing when to pull the trigger is the picture always seems like it'll be a lot clearer if you can get one more candle. But hanging on to see the next candle means you just never ever make the trade. But I mean, to look at Garmin specifically, I mean, it already kind of filled this gap and then came back up, which, you know, if it's going to fill the gap, you'd like to see it kind of touch off and go there. You know, it looks like it should have some support around this 62.40 level here also. Now the other side of that is it looks like it may have some resistance up here around these highs because it's kind of failed to get much above there a couple of times. But yeah, for like an option trade, typically I like to see it settle down a little bit. Sometimes I'll do something the day after earnings. Sometimes I like to wait a couple of days just to kind of get an idea of what's going to happen. Right, Netflix is an interesting one to look at in terms of daily candles, because they got whacked and put on this green candle, which sometimes something will gap down like this and then just come charging back. In this case, though, this green candle was a mirage, right? Like you would not want to make a particularly bullish bet there. And so, yeah, in that case, you know, obviously in hindsight, you know, having a couple more candles certainly clarified the picture, and it's you know, wasn't a time to go bullish. But with Garmin, I don't know, Garmin, if you're making some kind of a relatively neutral trade and you can get some break even that's down near that support level, I think that could work. All right, so Yaz has a question about updates. Yaz, we do have a couple of products, Investors Keyhole that comes out during the day. Portfolio trades that come out after the close are based on the you know, most recent data available. But in terms of trade idea generator as a whole, it is only updated once a day with the previous day's closing information. we do get requests for more frequent updates periodically, but there are some costs there that are not trivial. But it is a thing that's kind of on our wish list, but I don't really have an update or a time for you at the moment. All right, so Rick had a question about a couple of portfolio positions. Let's do IWM first. Yeah, so IWM it looks like it wants to come back. I hope it wants to come back in any case. But we'll be doing something on that in the next couple of days. I'd like to think we could get out for a partial profit, but we'll see. If we can have a decent day in the market tomorrow, I think that should be achievable. But either way, we'll be sending something out on what to do with that, because that is closing this week. And then Google again. Google got whacked by the Facebook and Twitter results, which the market doesn't really care when I tell it it's wrong, but we'll be doing something on that as well. That one I don't really expect to come back. Hopefully we can get out for less than the full $4, but that's the other one that's closing this week. And then we've got J&J, which is next week. This one's actually a bearish position. And yeah, it really sort of blasted through the resistance that we had identified. This one I'd like to see come back to earth a little bit, but we'll probably be, probably not this week, just because with the market as unsettled as it is, I don't feel like waiting really hurts us. But if we can get it to come back to earth a little bit, we'd probably take a small loss if we could get it. And then bots. Yeah, bots has been frustrating. It has kind of built this base here. So we're kind of hoping that it will kind of keep rising here. It did pretty poorly there for a while, but iRobot really helped it out with a good earnings report, and some of the other components there have done well. So if we can get sort of a minimum of headlines about tariffs and another good earnings report or two, I feel like bots we should be able to get out of. I don't know what our chances of turning that back into a winner are, but I'd like to think we should be able to get out of it for less of a loss than that 370. All right, we got another 15 minutes or so. If there are any more questions, I will be happy to answer them. As the trades get pushed out pretty early in the morning. I don't know the exact time. I want to say 6 or so, but it may be earlier than that. It certainly shouldn't be any later than 6. That's 6 a.m. Eastern. But yeah, it should be sometime a couple hours before that even, I would guess. We don't get data from some suppliers upstream until midnight or 1 usually, and that's just because of the volume of options data, and then they like to go through and make sure we don't have bad bad ticks or anything like that. So they go through and actually make sure that all the data is good before they ship it to us, which is good. We used to have problems with not such good data that we got earlier in the day. But yeah, that is about the earliest things get put up there. Ted, I don't know practically in the portfolio that we've ever legged out of a vertical spread. It's something we've thought about once or twice. But I've never actually pulled the trigger on. I certainly have thought about it once or twice, but typically when I'm trying to get out of one of those, I kind of just want it to, yeah. I'm kind of not interested in taking on a lot of extra risk. And I think legging out of that usually would be putting a little bit more at risk. So that's the reason we haven't done it. But that's not to say that we won't in the future. I just haven't done it yet. All right, so Nancy, I'm going to guess you're asking about a short put versus a covered call. There isn't really such a thing as a short covered call, but a short put or sold put is very similar to a covered call. Let's click through and look at one of these here. Yeah, so if you compare the two, the strike price is a little bit different in terms of the covered call and the short put here, which accounts for the difference in profit. But from a risk perspective, they're very similar. You have sort of a capped upside, and then you're on the hook for the stock all the way down to zero. Essentially, a short put, if it doesn't work out, you end up in much the same position you do with a covered call, which is you end up owning the stock at some price less than the a cost basis that is your, well, for a short put, it's your strike price less your credit. But if you had a stock you liked and you didn't want to buy it today and sell a call against it, selling a put against it, if you're happy owning the stock at a slight discount to today's price, selling a put against it can be a perfectly good strategy. And then, if it doesn't work out, you own the stock and you can sell a call against it and turn the position into a covered call at that point if you're interested. So, Sylvia, I'm not 100% sure I understand your question about Skechers. We did have a couple of positions on over Q1 earnings. That was because we got bad data about when their earnings report was and kind of blew that one. We did close the Skechers trade in the portfolio prior to second quarter earnings, or at least in the covered call portfolio. We did, why we can go look at that. I put some notes out on the diagonal spread. We ended up guessing wrong there, but I tried to be as upfront with people as I could about what the risks involved were. So yeah, what we did was we ended up holding it through earnings again, just as a long call, hoping that it would come back, and it didn't. And so we ended up, with a bigger loss than we could have had we gotten out early. But I tried to telegraph to people a couple of times in terms of this note and this note that there was another course of action that you could take that would do a different strategy if you're interested. So if you're talking about Skechers being on the trade idea generator, I mean, yeah, we try to pick a trade for every stock so much as we can, and so I'm not surprised it was there. After that big drop, it would have gotten a relatively low stock score report rating and a few other things. So I don't, yeah, I don't know exactly. If you have some more information about the exact situation you're talking about, I'd be glad to discuss it with you. But I don't, yeah, I don't, can't really comment without a little bit more information. Yas, we would. Shorting a stock is not something a lot of people can do. You certainly can't do it in a retirement account. And with margin requirements and things like that, it's just more difficult than we really care to deal with. We do have short diagonal spreads. So instead of shorting the stock and then selling a put, what we do is we buy a relatively deep in the money put and then sell one that's closer to the money. It's the same as the call diagonal, but upside down. And so it's a relatively similar trade, but it's doesn't require a margin account or anything like that, and gives you a similar exposure. All right, I don't see any more questions coming in. So I'm going to go ahead and sign off. We, as always, will be posting this recording and the slides on the blog, or sorry, in the Market Intelligence Center tomorrow, and we'll send out an email with a link at some point after we get that up. And then the next workshop will be on the 22nd, which is 3 weeks from today. It'll be at 4 p.m. Eastern Time. And I hope to see all of you there. And don't hesitate to give us a call, or if you have a question between now and then, you can hit us up at this help button, and we will get back to you there. So I thank you all for coming, and thank you for subscribing to Investors Observer. And I hope to talk to you again soon.